From the morning reading, the Q's all-time new high close, Spider new intraday high, earnings reactions lead the SPX and the NDX. 4 of 9 sectors moved higher on Tuesday. XLP, XLV, and XLK were the strongest sectors, while XLE was the weakest sector. All futures fell 12 cents to close at 42.75. Breadth strengthened compared to the prior session as advancers led 1583 to 1366 on the New York Stock Exchange and led 1459 to 1145 on the NASDAQ. Also in the morning reading, VIX seasonality has troughed. As stocks often meander during the dog days of summer, the VIX fear gauge has shown a consistent pattern over the past 20 years. Part of that pattern is that it tends to bottom around this time of year. ETF traders are betting on that tendency. Money has been flowing into funds that bet on higher volatility while leaving funds that bet on lower volatility levels. Extremes in these flows have been a consistent non-contrary indicator suggesting a higher VIX in the months ahead. Volatility and the volume go hand in hand. Along with lower volatility, there has been an exceptionally low volume in the major ETFs, not uncommon for this time of year. But it's extreme even when compared to volume in the underlying stocks in the ETFs, particularly the SPY. This suggests a high level of comfort holding stocks. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:01 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 10th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Sorry about that, I had to cough. So anyhow, let's get back to this, and let's go to our morning report. At the time of this cut, all 4 broad market indices were just above scratch, nothing of significance in their action. In terms of crude oil, it is down by about 0.25%. Euros up about 0.7%. Bonds up about 0.4%. And gold is up about 1%. In overseas action, slightly mixed. China down about 0.25%. Hong Kong up just above scratch. Japan just below scratch. Germany down about 0.25%. And United Kingdom down just below scratch. So in the broad indices and in the overseas futures markets, pretty much just rotating around scratch. Looks to be very small price action. In terms of macroeconomic reports for today, you have the weekly crude oil inventories, also JOLTS job openings, and a 10-year bond auction. I'm looking forward to tomorrow. You have the weekly version of the unemployment claims, import prices, and nat gas storage, along with the 30-year bond auction. In terms of current volatility conditions, obviously very, very low, and with the short-term VIX, you're at a 10.49, skew just above the 135 threshold, so that continues to build. That's probably the most worrisome thing that we're seeing here. Other than these very, very low implied IV percentiles, only can go up in any kind of significant way. And indeed, the S&P's at a 1, as is the NASDAQ and the Dow, and the Russell's at a 0. So these are extremely low IV percentiles, and would beg that at some point that we're going to see some increases in volatility. No standard deviation moves were put in yesterday on a close-to-close basis. In terms of the charts, here's your futures chart. You see that we have been edging up, but very, very small body. Not a lot of movement in range, though it is positive and is tending to lead to confirmation of the recent breakout from last Friday. Also on the Dow, much the same kind of action. NASDAQ, Also the same, and remember yesterday had an all-time closing high on the NASDAQ as well as an intraday even higher number. And then on the Russell's doing the same thing. All four of these are just kind of edging up ever so slightly. Hard to make too much of this, but still it is positive, and we'll give it that much. In terms of crude oil, let's take a look at some of the other markets. Crude oil, of course, has had something of a bounce off of a bottom. We'll see if this sets up as a bear flag or if we've actually had a reversal and we start setting up additional higher highs and higher lows. So not to be yet determined. There's a lot of overhead resistance on crude oil. So just kind of keep that in mind. On gold, big action on the overnight on gold. And you see this, I've drawn now this triangle. And we keep talking about how gold is in a bullish pattern, but achieves that bullishness in a really, really messy way. So just kind of keep that in mind. Gold could be setting up for a breakout, but you know, in the past when we were expecting a breakout, it often kind of would shake things off or go sideways or even down before finally resolving to the upside. So if you're going to buy something into the gold and use options or anything like that, make sure you buy enough time and have enough patience and tolerance. It is a sloppy, hard ride on gold. But if you're patient, it would seem to be productive to the long side. In terms of, let's see here, bonds. Let's go take a look at bonds. Bonds are up, and but still relatively within a sideways consolidation range. So while up, we won't make too much of this, especially until we see equities start to actually make a significant move. Of course, kind of chicken and egg between bonds and equities, which one is pushing the other. Most people would tell you to watch bonds and watch the dollar and then see that equities will follow. But especially considering how big the markets are with bonds and currencies. Okay, let's see if there's anything else. I think it's really, really pretty calm on the charts today. I think we won't make anything more of it than there is at this moment. In terms of the daily report, our upper area, of course, is where we look at our market timing signals and the like. And what you've got here, still market phase 3, bull flagville is the expectation. Longer bullish legs than bearish legs. Also, in our 3 market timing signals, all still quite bullish. Portfolio investor posture for our first one from IBD is confirmed uptrend bullish. GMI index, perfect 6 out of 6, buy signal in place in 7-1. And the third one, stock charts decision point scoreboard, is somewhat sloppy and mixed. We've had several bearish signals come in recently on the short term, have not yet turned back positive, all against the backdrop of mixed long-term signals. And also we know that these intermediate term signals are, had some danger of going to intermediate status or neutral status. So it's one of those things where the consensus here is still clearly bullish, but because of all this sideways action we've had in the last 3 weeks, it's certainly not an easy, healthy bull. Position sizing opinions on both models still at 100%. Intermediate term market posture still very, very strong bulls across all 4 indices and further supported by a bullish sentiment line. Strength of trend, very strong. Hedge warning status still at 0+ normal with some cautionary aspects. In terms of the special strategy opinions, we still have the one kind of borderline acceptable being our option income strategies. And it's borderline acceptable not because there's an expectation of something, super, super difficult, but that the VIX is so low that the premiums that are currently being paid are borderline acceptable to be able to take on the amount of risk So when we drop below 12 on the VIX, we call into question, the new positions for novice traders. Cover calls and put selling, no changes here. Still very much a go forward for novice traders. Condition is the opinion. No other really changes there. In terms of the specific warning areas, still these 3 low-grade warning areas. When I say low-grade, the skew now up over 135. It's more of about a 12% probability of a 2 standard deviation move in the next 30 days. And while we look at this as to start calling it a warning status when it goes up over 125, 135 is the real kind of harder level of warning. So we should start paying more attention to this skew, and that many times within several days of hitting a 135 often does produce a significant down move in the market. In terms of other areas, trend-based, all solidly bullish. Key intermarket risk aversion indicators all solidly bullish, though these lines are relatively close. We'd like to see some greater angle and separation. In terms of short-term sentiment, the intermediate-term sentiment is somewhat elevated, and indeed on the fear and greed index, we're up in the upper quartile. It has been scrubbing down just a little bit, but it's still in that upper quartile at an 80. So look for reversal patterns from those sentiment indicators. In terms of sector specific, you see we continue to have problems with especially the defensive sectors, some higher beta sectors, but we got telecom, consumer staples, utilities are struggling of late, but you also have consumer discretionary, energy, and retail also showing some deterioration. So this is not just about a risk on or risk off rotation at this point. And you see yesterday's performance, nobody really moved very far. Energy probably the biggest mover here at minus 0.5%. So I think that's probably enough for today. We're publishing a bit late, and we'll go ahead and hit the disclaimers as always. Hit the pause button if you need more time to review the disclaimers, and also note the hyperlink down here at the bottom for the full set of disclosures. So let's go ahead and get this published. In the meantime, we'll see you back here tomorrow for the next market preview session from Falcon Global. And good trading. Manage that risk. Go learn something.